Welcome to the latest in Sustainable Investors interviews with leading asset owners. Our subject today is climate scenario analysis, which is something of an important but controversial subject in that some of the models that have been used to date in the finance sector, including by investors, have to a certain extent understated the potential impact of climate change on key factors such as GDP, inflation, and of course asset values. The problem with this is that it has a potential for it to slow down the pace at which investors are incorporating climate change factors into capital allocation and stewardship decisions. One asset owner that's been taking the lead on this subject is the UK's University's Superannuation scheme. Now, in 2023, it released, in collaboration with the University of Exeter, a report called No Time to Lose. And in that report, it unveiled 4 scenarios that, and I'll quote, were designed to better reflect the real-world risks and opportunities that frame investment decision-making over the short and medium term. They took account of major macro factors, including extreme weather, geopolitics, financial markets, and technology innovation. So I'm delighted today to be joined by Mirko Cardinale, who is Head of Investment Strategy at USS and who has led the scheme's work in this area. Mirko, welcome. And I'd be grateful if you could kick us off by introducing yourself and USS.
Well, thank you very much for having me, Chris. So my name is Mirko Cardinale. I head up the investment strategy team at USS. And really the remit of my team covers the whole spectrum of investment strategy decisions, really going from the very long run decisions on asset liability modeling and in interaction with the covenant of our sector, all the way to total portfolio management, so managing the interaction across our total portfolio with private and public markets, and the day-to-day rebalancing and more tactical investment decisions. I've now been at USS for 10 years. And we have been working on climate and climate scenario analysis, as you mentioned, for the last 3 years.
Okay. So let's go back to the kind of start of that work, perhaps, and think about what you have, the steps that you took in the first instance before the updates that were mentioned in your recent TCFD report, and also perhaps maybe the place to start would be actually to kind of delve a little deeper into how pension schemes do use climate scenario analysis, and what are the risks of using ones that aren't up to the job.
Yeah, so we think climate scenarios are a vital tool because climate risk ultimately is a systemic risk affecting all of us as pension funds and investors. So really climate scenario analysis is a tool from our perspective to help us understand the financial risks that affect our portfolios under different assumptions around the energy transitions and the evolution of the climate. Clearly, as you mentioned, there are different approaches, and we have identified some shortcomings in what I would call the traditional approaches to climate scenario analysis. And this is why we decided to pioneer an entirely new approach back in 2023. And I think if I could just summarize what are, in my view, the main shortcomings. So the first one is the modeling of physical risk. Modeling of physical risk and extreme weather events tend to be highly simplified and doesn't really leverage the latest insights from the climate science. The second problem is modeling the energy transition in isolation, as if everything could be assessed through changes in pricing, and especially changes to the carbon pricing, isolating the transition from everything else that's happening in the real world, like geopolitical developments, like trade wars, like the development of new technologies like AI, etc. So that's the second problem. And the third one, this probably compounds all of this, is the focus of traditional analysis on very long run time horizons, which really compound the uncertainty. So really what we did in 2023 is tackle this three problem head on and try to come up with a new framework to address them. So explicitly bring in input from climate scientists. So we had Tim Lenton, one of the leading climate scientists in the UK, involved in a working group on the No Time to Lose report, and we explicitly focus on a short-term time frame, so 5 to 10 years, 2030, and explicitly integrating the energy transition with everything else happening in the economy and the real world. So that was really the focus of what we did back in 23.
Mm-hmm. Sounds quite a multi kind of disciplinary kind of exercise, really, in order to kind of bear in mind those many different kind of big kind of mega trends, really, that are kind of going on and impacting each other. Yes. In lots of different ways. So obviously you kind of laid out your kind of 4 scenarios in the No Time to Lose report, but you recently have updated. Obviously, it's an ongoing project. I'm sure Indeed. It hasn't been kind of left to one side at any point. But in your in your recent kind of TCFD report, you refer to a kind of an updating of the models and the frameworks. So, be interesting to get a sense of how you went about that and what you were looking to achieve.
Yes. So we in the work that we've done over the last few months and leading up to the TCFD report, we focused on a number of areas that where we thought that we could improve upon what we did in 23, ultimately to end up with a framework that is truly decision useful, that can really apply to the investment strategy and the risk management process. That was sort of the ultimate goal. So for the first thing we did is significantly enhancing the modeling of physical risks. So physical risks were already included. As I mentioned, Tim Lenton was part of a working group, but we really took that a step further. The aim was to come up with a geolocational map to understand how different parts of the world are potentially exposed to different climate hazards like droughts, like wildfires, like typhoons, to really help us understand how extreme events could affect the assets that we're exposed to in different locations.
That's got really granular, hasn't it?
Yes, it is very granular. There is a 1 kilometer by 1 kilometer grid, and we really try to understand the likelihood of a particular event occurring, like a wildfire, and how that can change because of the climate developments, and also what is the potential impact on economic activity in that particular area. So, and then, of course, from the granular map you can aggregate. We're actually incorporating this in our country risk framework, so we can identify what countries are particularly exposed, and then we can also identify whether a particular location within a country is particularly exposed, and after we can cross-reference that and cross-check that, looking at the assets that we own in particular locations. So that was really the first thing we did. The second thing was, while maintaining the framework, the narrative scenario framework that you described, where we had this neat 2x2 matrix. On the one hand, we have the policy development and the policy focus on the energy transition. On the other, with the dynamism of the private sectors, to what extent the private sector is able to come up with solutions, tech-driven or otherwise, to support the energy transition. So we maintained that framework, but we updated the narratives, and also we focused on understanding more in depth how the narratives could affect key macroeconomic variables in the different scenarios like GDP and inflation, but also how they could affect the energy system, so carbon emissions, energy demand, and and other factors, like, for example, the underlying mix of sources within the electricity sector in a particular country. So really the focus was try to understand what the scenario actually means for key variables, both on the energy system and macroeconomic variables. The final thing, and this is work in progress, is understanding how the scenarios affect specific sectors and specific companies. So going from the macro to the more micro, and this is a huge effort. And we are working with University of Exeter and the spin out from the university tracks to help us calibrate, so downscale the impact from the aggregate economy down to a specific sector and then down to individual companies. And this will really help us understand our exposures to the energy transition and the different scenarios for specific companies, also help us in our engagement.
Okay. Thanks for that. No, I was been looking at the kind of updated transition scenarios and noting that there's quite a lot of difference between, for example, for want of a better word, the kind of most optimistic and the most kind of pessimistic, or the most kind of smoothest transition versus the most uneven and bumpy and less coordinated, let's say, obviously those are. It'd be interesting to get a kind of sense of how those are put together, but also to get a sense of what you take from those four very kind of different scenarios and how you practically use those prepare for those potentially very different outcomes.
Yeah, actually you highlighted one of the most difficult tasks, which is to convert the output from the scenarios into some practical investment implications. It is not straightforward. Clearly, if you're using a very traditional approach to strategic asset allocation, where you focus on modeling expected return and expected risk in one central scenario, it becomes quite difficult to integrate fully the output of the analysis. So you need a more flexible approach, which we developed at USS over the last few years, where you blend quantitative analysis with a layer of judgment. So when it comes to translating scenarios into implication, the first thing we do is try to understand the common themes across the scenarios. And one common theme that we identified is inflation. So the reasons for the underlying inflationary pressures are slightly different in the different scenarios, but all the scenarios point towards sort of lingering inflationary pressures in the next few years, from a combination of the energy transition specific aspects and generally supply shock and supply side dynamics. So that really help us derive the practical implications, and then we focused on strengthening our focus on inflation protection in our portfolio through a mix of pure inflation hedging assets, which are also included in our liability hedging program, but also assets that give us protection, not explicitly, but are expected to behave well in inflationary scenarios. So that's one aspect, the common themes. As you mentioned, the scenarios are very different, and some, if you think about other variables like GDP growth, they point to very different directions. So there is you can imagine a very optimistic path where a virtuous cycle of technology and investment actually deliver a significant economic boost, or you can imagine a very negative outcome, like a meltdown scenario. And the spectrum, when we calibrated this, the spectrum of outcome in terms of GDP over the next few years is staggering. It's the difference between the most optimistic and most pessimistic is about 4% per annum. So you're talking about a scenario like the global financial crisis relative to an exuberant scenario like the late 90s. This is the spectrum of what could happen. And so this is harder to incorporate into decision making, but obviously there's a few things you can do. For example, we we thought that when thinking about exposure to equity assets and growth assets in general, you need to achieve a balanced allocation between companies with more resilient cash flows that can give some protection in the downside scenarios, and companies that actually are able to benefit from sort of tech-led disruption and the opportunities from the energy transition. So it really calls for a more active approach. So the market cap index and a passive fund would not necessarily give you that. So active approach and being aware of how the equity portfolio is put together to ensure adequate balance. The other implication that we derived is that because of the uncertainty around the scenario, but also the uncertainty around the path. So there is one specific scenario, boom and bust, when where there is a significant downturn followed by a recovery. So the best thing you can do, rather than try to pinpoint or exactly understand when the turning of the cycle is going to happen, is to be prepared. So we strengthen our focus on resilience to ensure that our portfolio can withstand a severe market shock, and also we are able to reposition our portfolio to take advantage of opportunities should a significant shock arise. So that is obviously what you can do to prepare for these scenarios that could occur realistically over the next few years.
Indeed, thank you. Now, obviously, the analysis is very important for asset allocation decisions, but also for engagement. And it was notable in your kind of TCFD report, there was an emphasis on the importance of universal owners such as USS and other big asset owners who are kind of stepping up their engagement, and not only with the high emitting firms in their portfolios, but with policymakers and also with other investors. So I was wondering how you might expect the updated climate scenario analyses to inform that kind of climate-related engagement activity.
Yes, when we published the first report in 2023, we deliberately made it a public good. So we want the analysis on scenarios to be made available to policymakers, to investors, to other institutions, so that they can also make better decisions. And I've actually had quite a lot of conversations on the back of that with some of our peers in Canada or in other countries, and also policymakers are also expressing interest in understanding better the framework that we developed. So clearly, as I mentioned at the beginning, this is a systemic risk. We cannot fully diversified away from climate change. We need to help policymakers and businesses manage these risks appropriately. So hopefully the scenarios can provide input into those decisions that policymakers and business need to make. When it comes to policymakers, the scenarios have implications for the type of policy that might help or the type of policy that might not help a successful energy transition. So we plan to use that in our engagement with policymakers to really help them understand the trade-offs that they face and how could a successful energy transition be delivered? What type of policies should support that? One of the areas that we've specifically worked on in collaboration with Exeter is the idea that you need a targeted approach to different sectors rather than sort of one-size-fits-all model where everything is achieved through a single carbon price. You need targeted policies. Some sectors are more advanced in the energy transition, like the electricity sector in the UK. Some, like steel or cement production, are much further behind. So you need a different framework for different sectors. When it comes to companies, the analysis, especially as we apply that at the bottom-up level, can provide some important important findings that can support our engagement with companies. We questions like how would your business model survive if there is a significant drop in oil demand, is an example of the type of engagement that the scenarios would enable.
And presumably it's also has the potential to inform the balance of your use of your kind of stewardship engagement resources, presumably in terms of, okay, we really got to kind of get a different perspective on which sectors to engage most with.
Yes, absolutely. It will help us focus our efforts on countries, sectors, and specific companies that are particularly vulnerable to alternative assumption around the energy transition. So, as I mentioned, we have not fully completed this process, but once we have completed the bottom-up analysis, we'll be able to really assess the vulnerability of revenues, bottom-line profits of different companies under alternative scenarios. And so that will help us prioritize our efforts on companies, not necessarily companies that have the highest emissions today, but companies whose business model might be more at risk, depending on which scenario is going to play out.
And I suppose that leads into kind of my next point, which was to be diving a little bit deeper into the kind of the work on physical risk scenarios. Presumably, you're kind of getting a clear idea of, regardless of their own emissions, the kind of resilience of different companies. And markets and assets is going to be kind of somewhat dependent on their physical location and the kind of circumstances. So, both from a kind of asset allocation and a kind of stewardship perspective, what does the kind of deeper dive into physical risk scenarios kind of suggesting?
Yeah, this is a separate work stream from the transition. And really, I think one of the innovation from our approach is really you can disentangle physical and transition risk. Physical risk are almost independent of the transition scenario. They are baked in over the next few years. Transition clearly can play out differently. So our focus on physical risk is really to understand over the next few years what locations are more exposed to both acute and chronic physical risk. We focus on the main hazards like river floods, wildfires, heat waves, drought, etc. So the work really help us understand the exposure in specific locations. For example, for the UK, the UK actually comes out reasonably well in terms of it's less exposed than other countries to some of the worst hazards, but it does suggest that droughts and river floods are becoming important issues, but some locations are more exposed than others, which of course can then be incorporated in our assessment of our exposures within the UK. Clearly, some acute and chronic risks like heat stress are becoming very severe in some emerging countries. So we are capturing that as part of our country risk framework. We explicitly incorporate now physical risk as part of the country risk assessments. And then when it comes to evaluating our exposure to assets, equities, foreign exchange in countries like India, Indonesia, or Brazil, then physical risk comes as part of the equation. We'll explicitly consider that. When it comes to companies, there is a bit more work to do. One of the hardest things is to understand exactly where company assets are located. And really understand the physical risk exposure to companies is very hard. Some providers of off-the-shelf product will present data that are not necessarily reliable. So we are working to come up with a more robust framework. We really require an in-depth understanding of where physical assets of being data centers or production facilities are located, and also which of these physical assets are critically important to the business. So it can be, but the analysis can be used for ad hoc assessments. We've already done that, comparing data centers locations of they were known for a particular company, but to understand that fully, we need to complete this work.
Mm-hmm, mm-hmm. As you kind of hinted there, you identified a series of kind of acute and chronic hazards, and it did kind of catch my attention that the single chronic hazard was kind of heat stress.
Yes.
And the impact and certainly I think one of the examples I've noticed has been the potential for heat stress to impact workers in certain industry sectors. I guess construction is going to be one, but across supply chains and delivery kind of services. But I was interested to kind of get a sense of what your work has kind of identified as the kind of the biggest concerns.
Yes, the biggest concern is the impact on labor productivity in some key sector, as you mentioned, like constructions or other sectors that are more exposed to heat stress. In many countries where heat stress is becoming a severe chronic risk. The US, or some part of the US, being included in the list of countries that are exposed. This will affect economic activity. Some countries have able to better withstand and to better prepare. So this is not the same impact across countries. Some countries have better prepared to adapt. If we take Singapore, will have more adaptation potential than Cambodia, for example. Mm-hmm. So that needs to be captured as part of the assessment. But ultimately, the economic prospects of countries that are vulnerable to heat stress are likely to be affected. Now, the exact quantification of the impact is difficult because there are many other factors at play, but it is nevertheless an important variable to consider when thinking about economic prospects of different countries, which then, of course, will affect the attractiveness of investments in particular countries.
Mm-hmm. I guess it's important to mention, really, isn't it, that one of the kind of key motivating factors here is about making sure that you have the information that you need to act in the kind of short and medium term. So what we're saying really is that a number of these kind of physical risks are likely to be manifesting themselves in relatively short order.
Absolutely, and in fact, as I mentioned earlier, physical risk is independent on how the transition is going to play out. Physical risk is baked in. Of course, if you stretch the horizon to the next 50 years, the transition scenario will matter, and you'll have different impacts on physical risk. But if you focus on near term, it's really dependent. The physical risks are there to stay. So that's why our focus has been try to understand exposures and what locations, what countries are more exposed than others.
Mm-hmm, mm-hmm. Okay, so I mean, clearly this has been a kind of this exercise. Ongoing exercise, but it has presented a kind of step change in your understanding and the information at the disposal of your kind of investment team. But there's kind of information is one thing and action kind of is another. We know that asset owners to a certain extent call the tune from being at the top of the food chain, but it's kind of I get a sense from some asset owners that there is a question of constraints on agency, constraints on your ability to address the kind of risks that from both transition and physical risk. I'm just wondering how you kind of assess that situation right now.
Yeah. So clearly, focusing on reducing the carbon footprint, which is what pension funds have done of the last few years, is not enough. Mm-hmm. Because we know, we've seen the trajectory of carbon emissions, and we are no exception. Of many pension funds has come down, so the carbon intensity is now lower than it was a few years ago, but this hasn't really helped making progress in the real world towards the energy transition. So we need a more holistic approach. And by more holistic approach, I mean focusing on the engagement with like a systemic engagement with policymakers and other actors that could really help progress the transition. Asset owners, they are arguably at the top of the food chain. We have a role to play, but we cannot achieve that on our own. We need the businesses, we need policymakers to play their part as well. So clearly what we can do is, as asset owner, we can engage with governments. As USS, the largest private sector pension scheme in the UK, we have more of a chance to engage with the UK government, however, than other governments. But we can, through a networks, through the network that we develop with other asset owners, we can jointly engage and influence governments around the world. So there is a collective responsibility for asset owners to collaborate and to act to influence policymakers towards the outcomes that we're all aspiring to. And we know this is really thinking about the best financial interest of our members, because we know that a 4 degrees world is not, well, it's not a world we want to live in, nor is a world that is particularly good for the prospects of financial markets. So clearly we want to avoid that outcome. Well, the other thing I would say is that part of the engagement is about creating the conditions for assets that can benefit and support the energy transition are also attractive investment for pension funds like us. That will require engaging on ensuring that there is a stable and predictable regulatory environment and there is consistency in policy making, so that pension funds like us can invest in long-term infrastructure assets that can support the energy transition and other critical investments for a successful transition.
Mm-hmm. Okay. So I'm wondering what the kind of next steps are likely to be for this exercise. Obviously, you've kind of taken a big step forward, but I would imagine I might kind of think that the kind of increased and continued volatility in terms of policies across different jurisdictions might be a big factor. But I don't want to put words in your mouth. Yeah. How would you say you expect to evolve the framework further?
Yeah. So this is a framework that require periodic re-evaluation of the narrative scenarios. So we expect to do that on an annual basis. The focus is to really bring in all of the different macro drivers, and we have been working on technology and artificial intelligence, how the development of AI could change the economic and financial market landscape. Mm-hmm. We've been working on geopolitics to understand the new dynamics in international trade, which the policy action of the Trump administration. So our aim in our next update is to bring it all together into sort of a unifying framework. It's not really about climate scenarios. It is about understanding all of the macro drivers, of which the energy transition is one, but there are others as well. To understand what are the alternative states of the world that we might see over the next few years. So that's one aspect. The other aspect we're focusing on is understanding more in real time what is becoming more or less likely. So we're building a scenario tracking tool, which will actually leverage new technologies and AI to understand news flows, data releases in real time and help us understand what is becoming more or less likely in the scenario narratives.
Just on technology and AI, be interesting to get a sense of where you feel potentially the most positive impacts might be.
Yeah. Well, you can make a positive story about the impact on productivity. Productivity growth is a key determinant of GDP and ultimately economic success of different countries. So you can make a positive argument that wide-scale deployment of new technologies could boost productivity and GDP growth, create the conditions for economic boom, a bit similar to what we've seen in other waves of technological developments, like the internet revolution, for example. So that is the positive story. Of course, it is also possible that it's going to be a bumpy road, as we have seen also with the internet revolution. There could be a cycle of overinvestment and then readjustment. So it is not necessarily a linear path, but yes, you could make an argument that a radical new technology with multiple applications, general purpose technology like AI could ultimately deliver better economic outcomes, both directly in terms of helping productivity, automating tasks, speeding up other tasks, but also indirectly, like for example, enabling research into new discoveries in medicine and in other sectors. So there is a whole set of direct and indirect impacts that could potentially be very beneficial.
Indeed. And finally, Mirko, what would be the kind of main takeaways that you would want fellow asset owners to kind of glean from the exercise that you and colleagues have been involved with at USS?
Yeah, I will focus on a few. The first one is our experience shows that rather than focusing on precise quantification and arguing about every basis point in terms of the difference in return estimates between a scenario and another, it is much more productive to focus on the narratives and also make the narratives meaningful, make them relate to the real world and what's actually happening, rather than building scenarios for the next 30 or 50 years, which is an incredibly difficult task. So that's focusing on time horizon and focusing on the interaction between the real world and the energy transition is really important. The other point I would make is that the narrative scenario enable dialogue, both internally and externally. So we had a very interesting dialogue with our portfolio managers. For example, we were looking at the implication of the scenarios for oil demand, and there were different views that we tried to incorporate that in the analysis. So really maximize the dialogue. That will help enrich the scenarios and become an iterative process. In the original No Time to Lose report, we actually spoken to more than 40 experts across all different fields, and all of them provided useful input that obviously help us enrich the narrative of the scenarios.
Okay. Well, good luck and thank you very much.
Well, thank you so much for having me, Chris.